This is Bazaar Morning Call, broadcasting live from the CNBC TV18 Motilal Oswal studios in Mumbai.
Hello and welcome to Bazaar Morning Call. We are coming to you live from the CNBC TV18 Motilal Oswal studio. I'm Nigel D'Souza, and joining me today, we have Rima Tendulkar as well as Surbi Upadhyay. Well, guys, market's looking a little bit jittery, but it's Friday.
That's the cue that matters. You said it. We've made it through one more week with bulls in top form, and how?
Indeed, yesterday it was a good close, right, Rima? I mean, we were wondering whether or not we could conquer that 19,500 odd mark. We breached that, but the problem today is, European markets were selling off. The yields have moved up as well, and US markets as well ended on the back foot.
Indeed, I think today is going to be the first test of the bulls' resilience.
Yeah.
Right, because global markets are decisively lower. US markets have ended with a cut of 1%. The European markets are down anywhere between 2 to 3%. The key reason is the stronger than expected private jobs data. There is ADP, and that the ADP private sector jobs data has shown that in the month of June, the addition is double of what the street was anticipating. We're looking at a number of nearly 500,000, and the street was anticipating a number of 220, 230,000. Today, we will get the June employment data. This is the official data which comes out from the government. Is the labor market cooling off? That's going to be the big question. Up until now, all indications seem to suggest that the labor market is still on a solid footing. And that's the reason why yesterday, equities pushed down, treasuries went up. The two-year treasury, hit a 16-year high, the highest level since 2007, and traders are now pricing in a 90% probability of a July Fed rate hike. It's been in the price. We've been talking about it. The Fed itself has been reiterating that we are going to see 2 more rate hikes, but looks like a July rate hike is now baked in the cake. For our own markets, we've had a dream run. This rally started from levels of about 18,650. That was the intraday low on last Monday, right? 18,650, and now we've made it to 19,500. We're looking at an 850-point, rally. But now, as I said, today is going to be a test of this trend, of this momentum, because week to date, the Indian markets are sharply outperforming the global markets. Pull up the comparison, for the way the other markets have performed on a week to date basis. While the Indian markets have seen a rally of close to about 1.5%, the rest of the markets are down anywhere between 2-3%. We're looking at a 4.5% cut for some of the European markets in this week itself. Even when you compare it with the rest of the Asian markets like Kospi, Taiwan are down 1%. Seng is down close to about 2%. So the Indian markets in this dream run have outperformed quite, handsomely, and that's something that the street will watch. Just one more word, and that's about the flows. While yesterday the FIs pumped in the cash market, and they pumped in close to about 2,641 crore, the figure that we're looking at is the net of the FI inflow minus the DII outflow, and that came down yesterday. So that figure will come up for you on your screen. For the last couple of days, the net inflows in the markets were well over 1,000 crore rupees. In fact, over the last few days, it's been coming down, and yesterday, the FI inflow minus the DII outflow was a net inflow of just about 300 odd crores, significantly lower compared to what we've seen over the last couple of days.
Well, I take your point on the net flows, and that's an important point to track. Yeah. But I'll talk about the overall ratio of foreign liquidity in just a minute. The way I see it, we were discussing this yesterday, it almost seems like it's this no bear market. The bears are literally, they're very scared to come out and even show up on the street, because how do you bet against the serious momentum? What we've started seeing is a bit of a mini melt-up. The Nifty yesterday crossed intraday 19,500, and it has taken just 6 sessions to do that. That's why I'm saying the signs of a mini melt-up. The smallest of dips, 15 points, 20 points on the index, they're getting bought, and there is no new leadership also that's churning out in the sectors, barring IT. IT is the one trouble spot. But barring that, there's a lot of rotation going on. FMCG, for instance, came out with a bang yesterday. Rima's mentioned the NFP, the non-farm payrolls data, so I won't repeat that, but that is the big cue. And till now, the Indian market has completely ignored the global sell-off, which has been underway for not 1 but 2 days. Remember, yesterday was a big down day as well. We ignored it, kept marching on. Can we do that again today is the question. Asian markets are again down. Hong Kong was down 3% yesterday. It's down about 1.5% already. So we have to see if the bulls can really stand tall against the backdrop of this global weakness, or whether today is going to be a day where you book some profits. Gift Nifty right now down just 10 points. Look at that. Sharp contrast to what some of the markets in Asia are doing. Okay, the near-term indicators are suggesting that maybe we're heading for a pause. When one such indicator is the put-call ratio, and that's climbing towards the 1.5 handle now very, very swiftly. We're at 1.48 versus 1.37 as of yesterday's numbers. The nearest support that technical analysts will tell you about is the 5-day exponential moving average, and that comes in closer to 9,300 thereabouts, so just around that zone. Hardly any distance from where we are. So maybe that could be the first stop. As I said, every dip is getting bought. And the reason that's happening is liquidity. If you're looking at the kind of foreign money that's coming into the market, it's staggering. In 4 trading sessions alone, we have received 40% of the inflows that we got in all of June. So 19,000 plus in 4 trading sessions. Today is the 5th one. Versus 47,000 crores in all of June. That's the extent of the foreign money that's coming in. Domestic institutions have been selling off as well. The domestic mutual fund equity inflow, remember, month on month, they've been pretty weak. April and May were weak. We'll get the June numbers in the next couple of sessions, so we have to watch out for that. And finally, as I said, sector rotation. Today, I would watch out for Reliance as well. Reliance started its move yesterday. Can it build on that or not? The NCLT clearance is through, by the way, for the Geofinance merger. And then the Bank Nifty. Nigel, we all know, if the big banks really start rolling, HDFC Bank has been held back because of the merger. 13th onwards, it's all that is done and dusted. So we need to see. But, so far in this year, the Bank Nifty is still underperforming the Nifty. So if banks start sort of leading from the front, who's to say? But I think bears are finding it very difficult to bet against the sheer momentum and the flow of money in the market.
Well, that's right. Just looking at the setup, today that buy on dips theory is going to be tested.
Yeah.
Because global cues are really, really weak. And the FI positioning, particularly on index futures, that's worrying me a little bit. It's getting too easy, too cool. Yesterday as well, they added close to 10,000 long contracts on. The long-short ratio now is at around 73% to around 27%. But that's not the alarming part. For me, the net long positions now is at more than 1 lakh contracts, 1.02 lakh contracts. That's the highest since November 30th. And in the last 1 week, we're talking about the series that just started, they've added 50,000 gross long contracts in just 1 week. That's a 40% build up on the long side itself. So it's getting too easy for comfort. And just to, the reason I'm talking about this November 30th number is the next day we made the higher at that time, 18,888. And from there, we did see a pullback in the next 17, 18 trading sessions. Remember, things are very, very different right now. But when you have the FI long positioning, so complacent, so good, I'll be a little bit skeptical about how much higher we can go from here, just in the near term. Some kind of a pullback actually will be healthy for the markets itself. Now, looking at the options data then, the 19,500 put, well, that was very active. Yesterday, you had the premium at around 115 rupees. And on the upside, well, sky is the limit, actually, the way the markets are going. So I'll just focus on the 19,500 put. We're looking at support levels for the day, given that at some point of time, we could see a dip. So since there was writing being seen out there, the 19,375 odd mark of taking a premium of close to around 125 on an average, that becomes the near-term support. If that's broken, the uptrend is still intact till that 18,900 odd level holds out, which is the 20 DMA. On the Nifty Bank as well, the most active strike yesterday was the 45,000 put. Open interest build up of close to around 15 lakh shares, premium of around 170 rupees odd. So you're getting a zone out there in terms of the Nifty Bank support. You have around 44,830, just deducting that 70 rupees, 170 rupees from around 45,000. So you get that. And also, if you look at it, the 50 DMA is coming in at around 43,900. So that's a crucial mark. The uptrend is still intact. The SGX Nifty is not indicating a deep cash. But the way the FIs are so aggressively net long, I would prefer if there were some short positions in the system. It's appearing a little too complacent for me. So let's see how this goes.
Maybe a perfect setup for a bit of a pause today. We will find out.
Let's pause will be very healthy, actually, Surbi, because it's just going one way. It's becoming too easy out there. Select your stocks. But I think on the index, some kind of breather should be good.
Okay, well, as we get started, let's tell you what's lined up in the first half hour of the show today. We'll get you updates from markets across the world. Adrian Moat, investor from Hong Kong, will be joining in to discuss the global trade setup and how India is looking against that backdrop. Our research team, of course, brings you the CNBC TV18 list of top 10 stocks to watch out for the day. And at around 8:30 a.m., we'll do a fundamental stock analysis with Deepan Mehta, director at Alexa Equities.
On the equities, Chris Wood of Jefferies says greed and fears Asia ex-Japan long-only portfolio has begun the new quarter with a 45% weightage on India and a 17% weightage on China. He says that reflects greed and fear structural view of the relative merits of the both markets, India and China. He adds, still, from a near-term, a more tactical standpoint, for those with more benchmark-oriented mandates, there is now a clear potential, as there was late of last year prior to the reopening of China, that's the mainland market, of another bout of relative outperformance triggered by some out-of-the-box policy move. Most particularly as MSCI China is now trading at 10.2 times 12-month forward earnings, not so far from the low of 8.1 valuations that they hit in October of last year. So Chris Wood calling for some near-term outperformance of China versus India.
Okay, that's an interesting call. Let's move to the money markets now and get you a view on the rupee. Lakshmanan V of Federal Bank says FOMC minutes endorsed expectations of a 25 basis points hike in the upcoming policy, with majority members still concerned about sticky inflation and tight labor market. The rupee was volatile after 3 weeks, with the currency briefly touching a 2-month high of 81.75 to the dollar and then weakening to 82.50. He expects the USD INR pair to be in a range of 82.30 to 82.75 to the dollar in the coming days.
On the bonds, Lakshmanan V of Federal Bank says tracking the US bond market, which is trading above the psychological level of 4% on the 10-year, the Indian yields are also inching higher. In the coming sessions, domestic yields could inch towards the 7.18 to 7.2% zone, from where insurance and similar demand could emerge.
Well, we have a lot of stock-specific action for you on this Friday morning. We'll get to that in just a wee bit from now. In our special Top 10 segment, we're looking at Reliance Industries, Titan, Tata Steel, Dabur, Shobham, Phoenix Mills, Tatva Chintan, Subros, and Praj Industries. All of them on the back of positive news flow. On the flip side, you have Sanghi Industries that could be reacting to negative news flow.